Great, thank you, Ann. Okay, something just popped up and said we're being recorded. Okay, that's fine. See if I can get that to go away. I wanted, as part of the Business Law Section Board, to offer this program because it's something that I don't think hardly anybody is aware of. For about 37 years now, our group has been involved in advising business owners, executives, professional practices, and so on. And obviously that brings us into contact with retirement plans and all the regulations that deal with those. But when we first became aware of CalSavers, it was something that was extremely unique that nobody I had talked to had ever heard of. We actually wrote an article on this topic for Contra Costa Lawyer magazine in the April issue. But as it's progressed and as deadlines get closer and as the awareness of it has not seemed to expand at all, wanted to take advantage of having both Jeff and Eric available to us. So with that, Jeff, I'm going to turn it over to you to introduce Eric. Jeff and the Principal Group are one of the professional partners that we work with through Wells Fargo Advisors and through the Novak Group. So I was very pleased to have both of them join us. And with that, Jeff, I will stop talking.
Fantastic. Thanks, Perry. I very much appreciate it. And thank you, Ann and Perry, for setting this up. It's both a privilege and an honor to get to talk to everybody. So yeah, my name is Jeff Liggett. I'm here in the East Bay in Danville, and I work with the Principal Financial Group. We're one of the largest retirement plan providers in the country. Basically what I do is I set up retirement plans of all kinds for small and medium-sized businesses here in the Bay Area, all over the Bay Area, all over California. And most of it is done in partnership with Eric Peterson, who is with Hicks Pension Services. They're an administration firm that is responsible for handling tax filing, keeping companies within legal compliance as it pertains to their 401k plans. Eric's very well known. He's an expert. He's been doing this for over 25 years here in the Bay Area, so he's almost a household name in the retirement plan industry here. And what Eric's going to talk about is the CalSavers initiative, which is something that the state of California is forcing upon companies. I think Eric and I both agree that it is not necessarily designed in a way that's going to benefit most business owners in any way. So a lot of people don't know about it. As Perry alluded to, it is kind of, obviously there's been a lot of distractions lately in the world that have kind of deterred people from really noticing this. And it was originally deadline for June 30th. That deadline has been extended to September 30th as a result of the pandemic. So I'm going to let Eric go into that in detail and kind of explain to everybody what really you and your clients are facing and up against as it pertains to the CalSavers initiative. So go ahead, Eric.
All right, thank you, Jeff. And thank you to all our attendees for joining the webcast. And also thank you to the Contra Costa Bar Association and to Ann Wolf for hosting us here today. I hear that many of you are conducting business via webcasts a lot more than you have in the past. And myself, I'm getting more and more comfortable using webcasts. And I'm hearing that webcasts are quite an efficient tool for conducting business. I'm spending a lot less time driving to meetings, which is freeing up time on my calendar. And since we can't have live meetings, I guess this is our new normal for now, although I do miss those live meetings and being with everybody. So today we're going to talk about CalSavers in a quick and efficient webcast fashion. And one thing that we're going to do is a PowerPoint, so I'm going to share my screen. And we want this to be an interactive presentation. We want questions, and I think the way that we're going to do that is have any questions be filtered through the chat, and then Jeff will interrupt or jump in, I guess is a better term.
Yep.
And then we'll go from there. Now, can everybody see the see the screen, see the PowerPoint?
Yes.
I can.
Okay. So we're going to get into CalSavers. So it was a bill that was signed back in 2016. And so why did the government do this? So it's well known and understood that as a society, as a country, we are really underprepared for retirement. If we look at all the statistics on the average retirement, average cash on hand a retiree has, it's not enough. And therefore, most retirees have to also rely on Social Security, and they're finding that still there's not enough. I'm 58 years old. The average person my age in a 401k plan has less than $300,000. And we're here with Perry, who's a financial advisor. He can tell you that $300,000 is not going to do a 58-year-old much good in retirement. It's just not enough. And we look at the statistics all the way down the age bands, there's not enough. People are not saving enough. We no longer have the retirement plan that our parents had, where they worked 30 years for a big corporation and received a pension. It's called a defined benefit plan. Those plans are not in existence like they have been in the past. We really are relying on employees, the workforce, to save for their own retirement. And we're seeing that that's not happening. So to react to that, this impending retirement crisis, as they say, our state decided to try and do something about it. So they created something they called the CalSavers program, and they're mandating that employers adopt this program. And so we'll get into the program and what it's all about. I think we understand why they did it. So basically what they're saying is we have this program, and we're mandating that if you have a business in California and you have 100 employees, by September 30th, 2020, you need to either adopt the CalSavers program or have a suitable replacement plan, such as a 401k, a simple plan. There are different types of plans that employers can adopt that will exempt them from this mandate, from this state mandate. But basically it comes down to September 30th, 2020. If you have 100 employees, you have to do something. I think Perry mentioned earlier, I don't know if it was in our live discussion or in our kind of pre-discussion, that he is mentioning this to all different types of groups and is surprised how very few know anything about it or have even heard about it. So that tells us that we have this big deadline coming and action is not happening as it should. There's been a lot of discussion around who is an employee. What is the definition of an employee? I'll give you an example. I have an office, I have several, but I have one in Fresno. And as you can imagine, the predominant business out there is agriculture. And they have a very temporary workforce, seasonal workforce that come in and out. And they could have as many as 200 of those types of employees. But, maybe they'll have an office, maybe with 30 full-time kind of regular employees. So those employers think they have 30 employees. They're not counting these temporaries or the seasonal workforce. They all count. Or this part-time workforce, they all count. If you're an employee, you're 18, and you are paid by W-2 and have worked there for 30 days, you count. Another example of that might be a fast food restaurant where the owner has several different franchises all around the Bay Area. It's a pretty common thing to see. And all those temporary young workers who are 18, they don't work full time, they all count. So the bottom line is all those companies have to do something. And I don't know that they all realize that they fall under the requirement for this year. Now, if you have less than 100 employees, you don't have to get started on this right away. If you have 50, then you have until June 30, 2021. And I think, I can't remember if it was Perry or Jeff who mentioned that the original deadline for CalSavers with 100 plus was June 30, 2020. But then with the coronavirus pandemic, that has really knocked business down quite a bit. That was extended to September 30th. So it's coming. And it's getting to the point where we better hurry up because it takes a good 6 weeks to start a new plan. So we're halfway through, well, we're not quite, but we're getting towards halfway through August. September, that's our 6 weeks. So companies need to start doing something soon. So that's kind of who has to do it. And then we see that on June 30th, 2022, if you have 5 employees. So that's going to be almost everybody. Everybody has to do something. Now,
Hey, Eric, I hate to interrupt. Sorry. I have a question that just came in from Marta
Yeah.
Vanagas. She wants to know if you think the deadline will be extended once more.
That's a guess. And I'll tell you where my guess comes from. I'm kind of a student of this, obviously. I attend every webcast I can, and I read every news feed that I can. And one of the bigger speakers in our industry is an ERISA attorney by the name of Fred Reese. I joined in one of his discussions the other day, and that question was asked. And he's the one, you know, he's lobbying with DOL. He's talking to lawmakers all the time at the state level too. And he says, no, that there's no discussion of a further extension. So that's where it comes from. And I guess I should also share with you, you know, my research on this. I started researching this about a year ago, and the state of California, they have a CalSavers website, but it doesn't give a lot of information. So then you have to dig further and look for comment and see opinions. So this is kind of a combination of all of that. This is where I got my information. The stuff I'm showing you here is the stuff that there's a general consensus on. That question from Martha, I think it was, right? Jeff? Marta? Mm-hmm. Great question. That one is not covered at all on the CalSavers website. So you have to be attending other types of information sources to kind of be able to comment on that. Okay, so what is CalSavers? CalSavers is basically a program an employer signs up for. And in that program, they tell their employees the following. We are going to take 5% of your paycheck, and we are going to, unless you tell us not to, we're going to take 5% of your paycheck, and we're going to put it in a Roth IRA. So let's get our arms around that Roth IRA part. Most people do a retirement plan, number one, because they feel like they need money in retirement. That's probably number one. And it's made much easier for most employees in a traditional type of program, such as a 401k, where that is done on a pre-tax basis. So they are reducing their current tax bill by participating in a regular 401k. That's why everybody does it. I mean, I think we all agree we all pay too much in taxes. With that said, we are always looking for a way to defer that tax, to decrease our current tax bill. A 401k is a great way to do that. It comes out of our paycheck, and it's pre-tax. A Roth does not. In a Roth 401k or in a CalSavers Roth, that money comes out after tax. So we're losing one of the benefits of why employees in general participate in a retirement program. They know they need to do something for retirement, and they want that tax deduction. Those are the two big reasons that they do it. They also enjoy an investment in the stock market and the returns therein. But those are the three top. So California decided to put together a program and took away one of the prime benefits, the pre-tax. But that's what they decided. I have another problem with the Roth portion of it too. There's a limit on the amount that we are allowed to put into a Roth. And this CalSavers has that same limit, $6,000. So again, we have Perry Novak. He's a financial advisor, financial planner. I think he could share with all you that $6,000 a year for somebody my age, for sure. Well, let's talk about somebody in their 40s who wants to start saving towards retirement. $6,000 a year will not get you there. You will not be able to create enough income in retirement from that savings so that you can retire. You'll have to have other sources of income. So the Roth is limited to $6,000 and it's not pre-tax. Those are two big problems I see with CalSavers. There's another feature to the program that we're going to ask employers to do what we call auto escalate. We're going to ask them to take that 5% per year election and then every year bump that up by 1%. That's somewhat of an administrative burden we're asking employers to do. I can share with you that these types of administrative functions that they have, they are typically outsourced to firms like mine. You know, I'm a pension administrator, to Principal, to Perry, to firms like that. Those efforts are typically outsourced to us. And CalSavers, there is no outsourcing. The small business has to do it. And, you know, being that I have been selling retirement plans in the Bay Area for 29 years, I myself have personally set up 5,800 plans. I think I have somewhat of a feel for what business owners, some of their challenges. And one of those I often hear in a 401k is they didn't want to do it because they thought it was administratively burdensome. And then I share with them the outsourcing that goes on, and then, you know, they sign up usually. But with this CalSavers, there is no outsourcing. They're going to have to do it themselves. So that's another challenge I see with this program. There's also another issue. In Roth IRAs, for all of us who have a certain income, our modified adjusted gross income, we'll call that our MAGI. If we're married, filing jointly, it's probably most of us, and earning $203,000 a year, we can't do the plan. So business owners fall in that category most of the time. And I can tell you, business owners sign up for 401ks because they receive a benefit. They get to participate. CalSavers, they just won't be able to participate. So that's somewhat of a problem that a lot of people, especially in the Bay Area, I mean, that's not an outrageous income for married filing jointly. It's probably a regular income. They can't participate. And then the next question comes in on, now, how do we correct this? You know, what if that employer didn't ask that employee how much their spouse makes? And then the participant figures out, oh, I'm not supposed to be in this plan. I make too much money. Well, the correction for that, the penalty for that will be on the taxpayer. It's technically or legally not on the employer. Now, the worker, the employee is going to go to the employer and say, why'd you do this? I have this penalty. So in the end, that's probably going to be on the employer. That I see as an administrative hassle that CalSavers will present small businesses trying to deal with these types of programs. And, you know, in the 401k space where I operate, you know, mistakes are made all the time. And we have guidance from the DOL, from Department of Labor, on how to correct those mistakes. And that is volumes of pages on mistakes and how to correct. So we know how to correct. For CalSavers, there really is no comment on that or guidance on what to do with the mistakes yet. There will as they come up. But that also is problematic. Uh-oh. I went backwards and didn't mean to. So now, okay. Okay, so moving on, kind of what is CalSavers? Now the record keeping itself, where the money is held. I'm gonna move down. I think you can all see my cursor. Those are the investment options right there. It's a company called State Street Bank. They're gonna give you some target date funds, 2 global equity funds, and a bond fund. in a money market. And that's going to be the limit. So that's 1, 2, 3, 4, 5 different options. I can tell you in the 401k space, employees demand more than 5 options. Jeff and Perry work in this space as I do, much more on the investment side than I do, obviously. And they can share with you, I'm sure, that employers wouldn't put up with 5 funds. Their employees would demand more. But in CalSavers, that's what we are limited to. And there's something else that really bothers me about the investment portion of this. The first $1,000 that any employee has going into their CalSavers account must be in the money market fund. You have no other option. So that employee who's not that highly paid, 5% of their paycheck represents a small number. Maybe that's $50. So they make $1,000 a paycheck. It's not unreasonable to think. That's 20 payrolls before they have $1,000, something like that. That could be a whole year missing out on market return. Some years that wouldn't be such a bad thing, but in most years, we're going to miss out, and we are going to be losing out on return that we could have had. I don't know why they have that in there.
And I'm gonna chime in really quick, Eric, and just make a point on that. And I'm glad you brought that up. So typically with a 401k plan, there is a different cash alternative investment option than a money market. Just to use us, for example, we have a guaranteed fixed account with a stated annual return of 1.9%. When you compare that to a money market, which in today's interest rate environment is almost a negative return, if not a negative return, it's a much more attractive option. Just so that additional flexibility makes a big difference in a retirement plan. So I wanted to point that out really quick. Thank you.
Thank you, Jeff. The other thing is CalSavers came up to a conclusion somehow, not quite sure how, that one record keeper could handle all of this. In the space in the Bay Area, there's several different record keepers. Since we're here with Jeff, we're going to call Principal the premier one. But there are several. I don't know that one would be able to handle this volume of onboarding. What the state of California has estimated to be 20,000 new employers adopting a plan, potentially could be. And it's not like they really have the workforce to do that, the upfront onboarding. So the system, as I see it, and I've gone on and I've checked it out, it's really the onboarding process is all on the employer, talking to a website, trying to figure it out. They're calling me and I'm telling them, that's not my business. That's a direct competition to what I'm telling you that you should do. Then I tell them why the 401k plan may be a lot better. And they usually give up on the CalSavers. That's happening quite a bit. So that onboarding process all through a computer is pretty tough. I'll move on to the next slide. Employer responsibilities. I've talked on these a little bit, but I'm going to talk a little more on it. This one right up top is the #1 complaint I have. The employer is required to submit a full census to CalSavers, keep them updated. That means onto the census website. I'm going to share with you something that Jeff and Perry are also both well aware of. Small businesses, when they have to take money from payroll, from a 401k deduction to the employee, and send it off to the record keeper, to the investment account, Jeff's firm, Principal, when they have to do that, they oftentimes struggle with that and ask me to do it for them, which I do, obviously. That's a service that we provide. It seems like such an easy thing, but what makes it difficult is your payroll is one software. You forward that information over to the record keeper who has to intake that data. They may have a different format. They may ask the employer to amend that or change that data, restructure it so that it can fit into the investment accounts format. That's where the effort is. I'm familiar with the census and their uploading of payroll, and it is very labor intensive. And not only are small businesses going to have to do that, but they're going to have to update payroll. And doing that for 100 employees on a very hands-on process, that's going to be a struggle. Most business owners would not put up with that. They don't put up with that in the 401k space. They tell me to do it for them. They tell principal to make it easier. And we step in together and we do that.
Absolutely. Really quick, Eric, another question just came in from Marta. She is wondering if they have to comply with CalSavers if they already have a 401k plan in place. And the simple short answer to that is no. And I think that's a lot of the reason for us actually hosting this, is to let you know that your clients with small business, medium-sized business, any size business for that matter, if they have over 100 employees, if they do not have a plan in place currently, they need to put one in place rather than having to comply with this by September 30th.
Great. And Marta, we are going to cover that in a little more detail. But the way I'm talking about it is I'm saying you are exempt from this mandate if you have an adequate replacement plan. And I think that's the exact language they're using. And that would be any type of ERISA plan, which would be a plan like a 401k, a simple, a 403b. Those are the basic three plans that you can adopt and exempt yourself from the CalSavers plan. Moving along, track all eligible employees. I think that, so the employer has to basically, as soon as everybody's been there a month, they'll have to let them know that this plan, they're in this plan. If you don't want that 5% coming out, you got to let us know. This is what we call an auto enroll. 401k plans also have auto enroll. Again, plan sponsors don't want to be involved in the administration of an auto enroll feature in a plan provision. They don't want to do it. Again, that's outsourced. And what this means is small employers have to say, okay, this person's worked a month. We have to get them into the plan. And we have to set up payroll to take out 5% of that employee's pay, unless they tell us not to. We also have to give them all the required notices to inform them that this is happening. So this is all on the employer. I kind of skipped over provide enrollment packets. Census will mail the packets to the employer. It's a pretty basic thing. I'm not worried about that. I think small businesses can hand out information. Unless, of course, you're in this era that we're all in. With the coronavirus, COVID-19, and shelter in place, and don't go to your office. I'm not quite sure how we're going to get that to everybody. I guess the employers are going to have to send a package to everybody. Not quite sure how that's going to work for the employer. Again, another administrative hassle that we're asking small business to do at a time when I think, with the economy the way it is and with this pandemic, I think small businesses are struggling with a lot of administrative functions, HR functions, dealing with their employees not coming to work, but still trying to produce a product or make things work that way. So it's a little harder. And now we're going to add this. They also have to track, this is the employer responsibilities, obviously continued. The track that auto escalate, that's the harder one to track. That's where you're going to track, hey, this person now has been here 1 year and 1 month. Because when they enrolled, they had to wait a month and then they were enrolled. So they've been here 1 year and a month, and now we are required to bump it from 5 to 6 and keep doing that until we hit 8 a few years down the road. Employees can make a separate election to say the 5% is fine, but I don't want any bump. I don't want this auto escalate. Another administrative burden, cumbersome. Again, all on the HR department. Let's see, what else do I want to look at? I don't know that I want to mention a whole lot of this. They hold an open enrollment. I guess I will chat about this a little bit. So they're requiring that you have an open enrollment for everybody that opted out. And so that's after 6 months. So every 6 months, for all those who didn't participate, you have to have an open enrollment, which means you have to send them the notice again and say, in 1 month, we're going to do this unless you tell us not to, which means the employee will probably come back and say, I told you not to last time, and I don't want you to do it this time. But it's something that they have to do and track. And also on this auto escalation feature, which I think I mentioned earlier. Well, I did, and it's right up here, where we bump you up once a year, 1% a year. They have to opt out of that. We have to do that every 6 months. It's crazy. Again, as a 401k administrator, that's a big effort. There's nothing as a cost to join CalSavers. Back in one of the earlier slides was shown, and I didn't even chat about it. Maybe I'll go back there. I'm going to go back there right now. One of the slides talked about the fees for the investments. There it is. So that's, about, it could be anywhere from almost 1%, 0.8 to 0.95 or 1%. Those are the fees. So that's the cost. 401k plans with any kind of assets in them typically have a lower investment related cost than that. But anyways, so that's the cost. So when they say no cost, I think what they really are saying is the plan sponsor is not writing a check. And by the way, a 100-person company that looks at this CalSavers and says, I want no part of it, in fees would pay me about $4,000, about in that range. Let's call it 4 to 5. So that's the cost. That would be a check for an administrator like me to do it. Now, let's look at the employers who don't do this. So after 90 days, your penalty is $250 per eligible employee. So if you have 100 eligible employees, how much is that? It's $25,000. And if you go half a year, it's $50,000. Or hire Eric to run your plan for $5,000 a year. I mean, now I hear this other question. How is this enforced? Who's gonna be enforcing this? It's not like the state of California has a lot of revenue agents out there knocking on doors of small business looking for violations to the CalSavers. But that will be on I'm told that's going to be on the California state return a business is filed. That we file a federal return and a state return. There's going to be a question on there. Do you have it? So, I mean, you're going to have to say no. Then you're going to have to pay if you don't have it, or you're going to have to do something. So that's what enforcement is. And just kind of a side note on enforcement of retirement rules and penalties. And I always feel like I'm the enforcement. Your CPA, who does your business return, is the enforcement, because they don't let you do things that aren't allowable. If you do, they tell you got to pay a penalty, and they won't sign the return. I won't sign the return unless it's all compliant. It's filed proper. So enforcement's 100%, because the professionals that prepare your returns, they can't let you do it wrong. So enforcement's 100%. We're not doing it. The state's going to find out. I think Perry and I, in our pre-discussion, we all, the four of us, got on this CalSavers to make sure we could run the technology, make sure it all worked. And one of the discussions was there's lawsuits pending that are challenging this. And what I can share with you is all of those, all the courts that those cases were presented to or filed in, they said, you're in the wrong place. We're not going to hear that. And that was over and over. So they're saying that ERISA doesn't allow these types of plans to exist. But the real reason is that these aren't ERISA plans. These are IRAs. These are Roths. These don't affect revenue. So the feds are saying, you know, there's nothing here for us because you're not touching revenue. So when I listen to like Fred Reich and others who lobby to DOL, and when they're asked this question, they say all of those were thrown out. There's no legal challenge that's going to happen. This is happening. That's what I am hearing. Now let's look at our alternative. One alternative is to establish a 401k plan, a traditional retirement plan. Now, what I'm seeing, and if you can go back to that agricultural business I mentioned down in Fresno, because I have an office down there. And I mentioned that they have hundreds of seasonal employees, and they don't really want to deal with the administrative hassle of those employees, of bringing them on a plan. They're all temporary part-time. They would have to with the CalSavers. But in a 401k plan, we can have eligibility requirements that may exempt most of those, exclude those employees. So in a 401k plan, number one, we can say you have to be 21, you have to work there for 1 year, you have to be full-time. You'll notice here I said 1,000 hours. In retirement plans, the definition of full-time is basically half-time. It's those who work 1,000 hours a year. And if you want auto-enroll and auto-escalate and you feel comfortable about that, you know, that's outsourced to firms again, like Perry, Jeff, and I. You can have that. But the key point I want to make here is if you adopt a 401k plan, and it's only going to be your 30 in-house kind of office people that are full-time and meet the eligibility requirements, you're good. You have met the mandate. Those 200 employees who are seasonal never qualify for your plan. You have met the mandate. You are good. You don't have to consider CalSavers. So I think that's been a big relief to a lot of employers. Up next, you know, benefits of a 401k plan. Remember what I said the limit in a Roth is? I said it was $6,000. In a 401k plan, you can put in $19,500, a lot more. And remember I said that $6,000 a year is not going to get us to retirement. We're just not going to be able to save enough, even with compounded growth. We're just not going to be able to. Multiply that by 3, putting in 19.5, that can get us there. And then there's something called a catch-up provision for those who are 50 or over. You can go all the way to $26,000 as your deferral. And if you like Roth for some reason, you can choose that to be Roth in a 401k. You have that eligibility. And then here's something else I think is super important. In CalSavers, the employer is not allowed to put money in for their employees. It's only employee money. 401k plans typically match. Employers think this fringe benefit should come with some contribution from the employer to the workforce. This is a retention tool for them. This is a fringe benefit. So CalSavers plan doesn't let us do that. So a 401k plan does. Okay? All the money's in a trust, protected from bankruptcy creditors. IRAs don't enjoy that kind of protection, but in a retirement plan, we do. And it's also from bankruptcy to the company. Yeah.
Sorry, I want to interrupt. Another question just came in from Marta, and this one's interesting. Her question is this CalSavers just a smart strategy to encourage 401k creation and contribution? I'll let you go into it. Maybe on the surface it appears so, but The biggest problem with it is it's not tax deferred contributions, so the state still gets their tax dollars. So I guess the short answer, in my opinion, would be no. Maybe in an underhanded way, that's kind of what it appears to be, but I don't think that's what's being accomplished at all. And I'll let Eric take that one from here.
So, Marta, the result is that more companies will do retirement plans. That is the result. Count me as jaded when I say this. I think the reason the state is doing that is so that those running for office can stand in front of the electorate and say, we are doing something for employees. We are doing something for their retirements. I think that is the purpose. The net result is, I'm sure employers are going to look at CalSavers and say, this is not for me. I'm going to go do a traditional 401k plan. So it's the result. The reason why, I don't, I'm just being jaded when I say that. I don't know their reasoning, but that's my opinion anyways.
Here comes another interesting question. Sorry. Yeah. Were you going to finish? I apologize.
I was done there.
So this one came in from Stephen Melman, and he says, if there's a 401k with a Roth option, my understanding is that up to the limit on contributions plus the makeup amount that one can put money into a Roth 401k, even if the married couple make more than $203,000 or whatever the number you gave us was, which I believe it was 203. Is that right? A lot of people say that Roth IRA will want. A lot of people say that a Roth IRA one will end up paying less taxes because the growth is not taxable. Are you recommending against putting money into the Roth component? Interesting question. Did you understand?
I did. I'm going to talk to the first part. All right. So I'll do the first part first. I mentioned that we are ineligible if our MAGI, our adjusted gross income, married filing jointly, is above $203,000. As a family, we can't do a Roth IRA. We cannot. We're exempt. The law doesn't permit us to do that. In a 401k, there's an exemption to that. We are allowed to do a Roth 401k, even if our income is over that limit I talked about. So I think that answers the first part. The second part, am I suggesting a Roth over traditional? For myself, I am. My income is such that I want that tax deduction today. I think most of us on this phone call feel like we want a tax deduction today. But I don't want to make that as a blanket statement for everybody. Everybody should be advised to talk to their tax professional, their CPA, and devise a strategy they are most comfortable with. I will also add this. In a low income situation, maybe Roth is better because you are paying low tax. Taxpayers in the 40 grand range don't pay much in tax. So you might as well just pay it now. That's just opinion. But when we, the attendees here, myself, our panelists, when we're giving tax, when they ask us that, we don't know their whole picture. We can't make a blanket statement. We should all say, talk to your tax professional. And I can help them with that if they want to do a deep dive on it. Okay? What about the cost for a 401k plan? I kind of gave that earlier. Businesses with 100 employees in a 401k have an outside audit requirement. That is an extra cost. Sometimes we can avoid that by breaking the 401k into two parts. There's options that we have. But that's more on an individual planning basis. And know that every retirement plan is individually designed. There's no cookie cutter, one fits all type of program in the 401k world. Whereas this CalSavers, I think, is a one size fit all. That's not the reality in the 401k space. Every employer demands of Perry, Jeff, and I that they have customized features that best fit the employer and their workforce. They demand those. So that would be more at the individual level level, we talk about ways to maybe avoid an audit by splitting up the plan into two parts. Leveraging CalSavers. Normally I give this presentation to financial advisors, and I want them to go out and get the word out. I want them to talk to their CPA groups, HR groups, group benefit relationship advisors, payroll reps, get the word out. You'll notice this one here, Chamber of Commerce. I did this exact presentation it's getting on about 6 months ago. It was in January. Probably one of the last times I could meet in front of a group to a chamber down in Monterey. I had 100 people attend, all business owners, all members of the Chamber of Commerce. So obviously business owners. And I asked them who had heard of CalSavers before they received the invitation. None of them, 0 out of 100. So the word's not out there. So I hope you all feel the mandate that I do to get the word out so employers will avoid those onerous penalties, number one. And number two, put in the correct program. Put in a 401k plan if that's the best fit for the employer, which I'm hoping that everybody sees that in most cases that will be. So with that, it's question time. I think we did those as we go, but does anybody else have questions?
Eric, I do have one question. Were you going to talk about any of the provisions of the CARES Act? You know, we've been running into a lot of situations where people who are taking their required minimum distributions from their IRAs because of their age have decided under the CARES Act they're allowed to put that money back into their IRA, but only until August 31st of this year. We've been reversing a lot of those payments.
So yeah, okay. So obviously our government recognizes that the workforce is hurting and money is getting tight for some, especially if their hours are cut back or if they're unemployed. I mean, what are they going to do? Where are they going to get the money? If they have money in a retirement plan, that is a source for it. But as you all know, pulling money out of a retirement plans comes with penalties. So the government has decided that we are going to allow the workforce in this country to dip into their retirement and maybe not have some of those penalties. Give them access to that money. It's easier than it was in the past. This is different than, Perry, what you were talking about on CARES. I think you described what CARES is all about on the rollovers and the replenishing of the rollovers. So I'll let that stand. Yeah, I think you covered that part of it. But to me, the biggest part of CARES is employees who are struggling to get money, this is a place for them to go. So they may have read some of this, maybe in the news, some of this legislation, some of these ideas on how you can get money. The biggest problem, though, is if the employer is not going to allow it, is not adopting that language, then the employee's out of luck. So at my firm, we're saying that let's just have it. We're consulting with our clients. I have like 6,000 clients. We're consulting with those clients and telling them that you better adopt this because your employees who are hurting are going to want money. And this is the only place they have to get it. And that provision has to be adopted. You have to amend the language in the plan document. So that's a lot of the efforts we're putting in. Perry, the part where they took money out without an early withdrawal and they want to avoid it, they use that money for something, and now they want to replace that. That is a provision for those who have the financial means to be able to do that. So that is something that's out there as well.
Right. Thank you.
So my messaging, I hope everybody also sees that I'm worried about the worker, the employee. I want them to have an adequate retirement. I want to be part of that. That's what Jeff and I and Perry do as a living, that, you know, when you watch somebody that's been a client for 30 years and they can retire, that's a good feeling. I want that. But I also see that the workforce is hurting, and I appreciate the fact that there is access to this money, and I want to help with that as well. I mean, that's what we're here to do in the servicing business. That's what we do. But that means we're going to have to get disciplined in the future. If we take some of our retirement savings out today, we're going to have to be disciplined in the future to replenish that, put more back in. Sounds like Perry has clients doing that. So that's also some messaging we need to all get out there.
You know, I just want to chime in and kind of make one point to this, to the whole CalSavers initiative, and what I think is truly flawed at the core of it is we're talking about a lot of companies who have not put a 401k plan in place for the simple reason that the vast majority of their participants, at least they feel, won't contribute to the plan. Therefore, it's not going to efficiently work for the actual business owner. Now, we're talking about tax-free contributions to these plans, whereas what the government or California state government is forcing on companies is to make after-tax contributions at 5%. That's going to have a profound impact on these low-wage earning people's take-home paycheck. That's where the real headache is going to start for these plan sponsors, these company owners. So that's where I really think it's flawed, and I think it's an important message delivered to business owners, your clients, and companies that are out there that are going to be forced into this, because it's definitely going to have a profound impact on these low-wage earners. So that's just that's my passionate side about it. It's just, I think it's truly flawed for most companies.
So we didn't talk about who's going to wrap up. It sounds like our questions we don't have any questions. Who's our wrap up?
Well, it sounds like we've pretty much covered it. I appreciate both of you taking part in this, and I'm very happy that Ann is back there and that we're going to have this recorded and available in the archives. Hopefully, once the word gets out about this, there'll be some demand to watch the recordings and then some questions from there. Ann?
Yes, yeah, I agree with Perry. I think that there's going to be a bit of a demand later, and we may want to revisit this either with some additional attendees, either as a group participating in the chat during playing the recording, or just revisiting it and doing it again. But I think it's going to be something that's going to come up again. I think getting the word out is important, as Eric said. So tell your friends. Anyway, I want to thank you all, and we will. This will be on our self-study page at some point, and they can watch it there. But we may want to do this again live at some point in the new year, or when you all think would be best.
Would certainly love to be able to do that. And I guess I'll wrap it up on behalf of myself and Eric by saying, if anybody has any questions, or if you have any clients who are business owners who you think might be candidates for this CalSavers initiative, who may want to avoid what we think is going to be a nightmare for them, Eric and I are certainly available via Perry to help you out in any way we can.
Great. All right. Thanks, everybody.
Well, it looks like we may have had one more question come in that just popped up, and this is a very interesting one. Yeah. Jeff, go ahead.
Okay, I'll go ahead. This is from Nancy Gibbons, and what she wants to know is, what is the state doing to get the word out to employers? This is a great question. Is there a safe harbor before penalties are incurred? Great question for you, Eric.
So no safe harbor before penalties are incurred that I'm aware of. And I've looked, so there is not one. What are they doing to get the word out to employers? I don't see it. I get the news feed from CalSavers, and they'll have a rep go talk to a group of business owners from time to time, and they will talk about that. Make in the newsletter, hey, here's the people from CalSavers getting the word out, talking to this little group of business owners. So they're doing that. That's their reach out. But that newsletter comes very infrequently. I don't see it very often. I don't see a lot of that. One thing I do see, though, is letters going out to business owners. You either have to go online to CalSavers and show why you're exempt, from this mandate or you got to adopt. They're sending out letters to people telling them that. And so those of my clients who have a 401k plan, they're calling me saying, I got this letter. I say, well, you know, go on, let's go online together. Let's answer that you have a 401k plan. And then presumably they won't send you any more letters.
And then Nancy added a little bit to the end of her question. Is the agency EDD or FTB?
I don't know that it's either. And when you say, is the agency that's overseeing this? I'm not.
I believe that's what she's asking.
Yeah, the EDD is, look, it has been given some oversight.
Okay, are we good? All right, thank you, everybody. Have a wonderful, let's see, we're only at Tuesday, so I can't say have a wonderful weekend yet. But have a great rest of your week.
Thanks so much, everybody.
Take care.
Thank you.